All right, good Sunday morning, investors and traders around the world. Thank you for tuning in. I haven't done a video in a while. You might be able to recognize by my voice that I've caught a cold, and it's playing tricks with my voice, but hopefully everybody can hear me. With that being said, this video is going to go into a few of the different market achievements from this past week and year to date. As the title suggests, new bullish market signals triggered for 2025. Coming into this year, the Finom Group, S&P 500 by July, price target objective was 61.50. And that is at the lower end of Wall Street strategists' price targets. But that price target objective is in keeping with all of the data that we've compiled to forecast at least the first half of the year, if not through the month of July 2025. With that being said, do these new bullish market signals force us to adjust that price target objective higher? Well, to answer that question, of course, first things first, we've got to hit the initial price target objective of 61.50. All right, so let's go into a few of these concepts. Now, our Phenom group members, you're going to receive this video alongside all of the data that's being presented here, as well as the analysis first. And then, the public will get a chance to review all of this data inside this weekly video as well. So here we go. How to quant. So as most of you know, I look at the market through the three investing disciplines. And those are fundamental analysis, quantitative analysis, and technical analysis. Do you rank them in that order, Seth? Abso-friggin-lutely. I've learned over my 25 years of investing that they all play a valuable role in savvy investing and trading. Having said that, I've learned that technical analysis, while playing a role, does so to a lesser degree and has become less and less part of my overall investing paradigm. But it's not eliminated, don't get me wrong. You'll see I post publicly on X and other social media platforms, as well as within our macro market research report, a variety and quantity of technical charts. So we came into this year with the belief that January more than likely was going to produce a positive return, and you're welcome. Only kidding. Obviously, I didn't create the positive return. Phenom Group didn't create the positive return, but our analysis lent us to believe that it was the most probable outcome. And that's despite some of the bearish achievements that happened within the first 2 weeks of January. Nonetheless, it didn't dissuade one simple fact of, we had some really good, strong indications, not just the one that you see right here before you, but other indications that January indeed would be a positive month. Now, keep in mind where we ended 2024. The S&P 500 ended 2024 at 58.81. We undercut that low, and keep that phrase in mind. We undercut the 2024 December low in the first couple of weeks of January 2025. But even with that in mind, we believe that there would be a rally that would produce a positive January. The data here before you depicted, you may have seen in many of my previous videos. as well as in social media. The pattern recognizes that we've had 3 down Januaries that would be followed by 3 up Januaries or positive Januaries, followed by 3 down Januaries, followed by 3 up Januaries, then 3 down Januaries, and wouldn't you know it, again, 3 up Januaries. The pattern held true. Again, with a positive return, it satisfied the 3 up in a row. Now, if you're taking a look at this for the first time, what you're also recognizing is what comes next, right? 2026, more than likely, satisfies the start of a 3 down January annual period, right? 2026, 2027, 2028. If indeed the rule of 3 holds true, this pattern holds true, those 3 calendar years for the month of January will be negative. And if you think about 2026, wouldn't it just go to figure, right? A midterm year, which is the worst of a 4-year presidential cycle, starts out poorly. Midterm election years are the worst S&P 500 return years of the 4-year presidential cycle. Nonetheless, this was one indication. This is one pattern recognition, quantitative analysis that informed us of the probabilities for a positive January. Fast forward, and here we are in February. Now on X, or formerly known as Twitter, you may have seen this tweet whereby our models, based on quantitative data, inform that the S&P 500 at the end of February would be above 6,008. So how did we get there? The following quant here from Sentiment Trader informed us of this very thing. When breath is so bad, it's actually good. That is what the study above has proven yet again. At the end of 2024, the S&P 500 index ETF percentage of stocks at new highs was 0%. That's right, none. Breath is so bad, it's actually good. The forward 1 month return, if we look at the study here from Sentiment Trader, when this signals 0% of S&P 500 index ETFs at new highs, the 1 month later positivity percent is 90%, right? The win rate or positivity percent, 90%. Only one loss, and that was back in 2012. The study goes back to 2006, by the way. So fast forward to February, right? 2 months forward from the signal date, you still have a 90% win rate. Again, the lone loss was in 2012. So what does this mean so far as how do I get to 6,008, right? It's one thing to look at these kinds of quantitative studies, or quants as they're called. It's another thing to learn and understand how to take it to the next level to draw such conclusions for the S&P 500. Our signal date price, right, the end of 2024, 12/30, our signal date price was 59.06. Again, the positivity rate 2 months from the signal date is 90% positivity rate. So let's calculate. 59.06 times 1.73% equals 6,008. Well, Seth, how did you get the 1.73%? Again, here's what I did. So 2 months forward, I said to myself, what's the worst return? If we're going to be positive, not negative, but if we're going to be positive, right, we use quantitative analysis to lean into the higher probability outcomes, right? A positive return 2 months forward from the signal date and price. So I said to myself, what is the least return of the positive signals? The least return was 1.73% in 2016, right? I mean, I doubt very much we're going to have an 8% return, a 6% return, 9, 10, right? So I said, let's keep low expectations, maintain low expectations, as I always say. And if the market wants to jump over that, great. But what's the worst we can do? 1.73%. Again, just multiply that by the signal date price of 59.06 and you come to 6,008. And we have 2 more weeks to go in the month of February, or by February 28th. And so we'll see if this lives up to the outlook. Don't get me wrong. In this video, we're just explaining and displaying and analyzing one particular quant. The market is never doing one thing at any one given point in time. There are many quants to look at for any conditional period under review. But that's how we got there. All right. So, and that's one example of how to use quants and analyze them or take it to the next level to give you that much more actionable, right? Because if you fell below 6,008 at any point here in the month of February, this data tells you what to do when you're below that level, right? You should be buying because more than likely from the signal date, the S&P 500 would be higher, right? And so from 59.06, let's just round this out to 2%, right? You're talking about 6,100 plus, which is where we are. Oh, 6,000 plus, sorry. Math, it's early in the morning here on the East Coast. All right, now let's look at another study we have here. This one is from Steve Depp. As it stated, the following is a technical quant study, which we consider to also incorporate market breadth. I like technical studies because, as it says, it incorporates market breadth. It's a bigger picture study or a bigger picture quant. Technical market moves happen with some degree of breadth, be it weak or strong breadth, and as such envelope breadth studies, so to speak. I'm defining it this way as to suggest we like or favor such technical studies because we think of them as compounding signals. Again, bigger picture. So what is this technical study? From Steve Depp. So what do we have here in the study above? What should first jump out at you is all the white space, right? White is positive returns, positive forward returns. There's very little red on the screen, right? 1 month, 2 month, 3 months, 4 months, so on and so forth. There's very little red and a whole lot of white. White is denoting positive returns. Red is denoting negative returns. So the more white and less red informs that the technical study holds high probable higher prices to come. The signal date was the last week of January. Signal date was the last week of January. Let's see here. As Steve Depp informs, January goes in the books for the S&P 500 as a bullish outside reversal month. The 8th such time in January finished this way since inception. What does that mean, a bullish outside reversal month? Well, recall that December was a negative month or a down month. So if January is a positive return month, you have a bullish outside reversal month. It's just fancy technical jargon, to be honest. Now, when we look out here from the 8-month forward time frames, what do you see? There's no red on the screen. Is this a small sample size with just 8 total occurrences? Yes. But as I often educate people when it comes to quantitative analysis, this is not a controlled laboratory study, right? We're not developing pharmaceuticals here, right? We can't control the environment. You get what you get. The price action is what the price action is. Therefore, there's no sample size too small, no sample size too big. That's not how quantitative analysis works when it comes to the markets. Right? This is not a controlled study. You can control a study when you're developing pharmaceuticals, doing all kinds of healthcare and life sciences studies. You can't do that with the market. So those folks who say, well, the sample is too small, it fails statistical relevance. No, it does not. Again, don't bring, life sciences and medical studies. Don't let that cloud your understanding of what works and what doesn't work when it comes to quantitative analysis. Be that as it may, right? 8 months forward from the signal date, there's no red on the screen. So as usual, we go to our signal date price, which at the end of January 2025 is 6040, 6040. So 8 months forward, which I believe takes us to September. You do the math for me, please. I might be off by a month. The S&P 500 should be above 6040. Having said that, and thinking more near term, the 1 month, i.e., February, has an 85% hit rate, almost 86%. When we think about, what is something you can lean into as an investor or trader, I like 70% and aboves. This is 85% and above. So it's a very strong signal. So this is another way that informed us, we should not just be above 6008, as was our prior quant analysis, but possibly even above 6040 based on this quant. The strong breath readings over the last few days triggered one of my oldest and favorite studies. It looks at other time frames. It looks at other times that breath came in strong for 3 days. So now we're fast forwarding to quantifiable edges study here, which you can call it a triple 70 breath thrust. Now, this happened actually late last year, also in the fourth quarter, November 25th, just before the holidays. Right, the triple 70 thrust. It requires the NYSE up issues, meaning the percentage of advancing issues, to close at 70% or greater for 3 days in a row. There's a lot of positive numbers, and the edge generally appears to be to the upside, right? I mean, anything over 50% positivity rate or percent of winning trades going forward, these are the number of days past the signal date, 5 days past the signal date, 65% win rate. 10 days, 15, obviously goes in increments of 5 trading days. So week by week by week since the signal. But notice where it's highlighted here has the greatest win rate. Now, this one actually, again, signal November 25th, 2024. The signal date price was 59.87. Another way to use this kind of quant data, another way to analyze a how-to, if you will, is to look at the signal date price as a baseline. If it gets below this price at any time from the signal date to this area here, you should be a buyer. right? You're getting a discount because 75, 80, 85, 90 days from the signal date price, the S&P 500 should be higher. Spoiler alert, if you haven't already been, guessed, we are significantly higher now 80 plus days from the signal date price. Again, three different studies, all informing not just what you should be doing anytime below this price. And we were briefly below this price. Remember, we undercut the December low in the first 2 weeks of January. We got down to 58.27 on a closing basis. What should you have been doing based on this? If not, this, well, you didn't know about this at first, but definitely a breath thrust, right? You should have been buying. You had a high, very high probability here in the 90%, that 80 to 90 days from the signal date and price, you'd have a positive return if you only bought the Spider ETF or the S&P 500 Index ETF. With all that good news out of the way, right? For February, possibly finishing above 6,008, possibly even having another positive month for the S&P 500. Bad things tend to happen to the market at the final 2 weeks of February. The final 2 weeks of February historically are the worst 2 week returns since 1928. Going back to just 1950, right? If you're thinking just the post-World War II era, it gets a little bit better, but not much. It becomes the third worst 2 week period of the calendar year for returns. All right, next week or this coming week is monthly options expiration week. Go figure, right? Monthly options expiration weeks in the post-COVID environment have been the worst in history. Prior to COVID, it really wasn't that bad. But post-COVID, for some reason, monthly OPEX weeks have delivered negative returns more often than not. So just a heads up here. Now, there's no guarantee. This is the average performance. It's not the every single, final 2 weeks of February performance. It's the average performance. Additionally, while we may fall over the next couple of weeks, to what degree, we just don't know. We just don't know. So do keep this in mind. All right, now we started this video by recognizing in the title, new bullish market signals trigger for 2025. Well, what are those triggers? Well, we've already talked about the breath thrust here. We've talked about the, bullish outside reversal months, right? Those are some positive bullish signals. But we also had the Valentine's Day indicator flashing green as of this past week. This table here is from Ryan Dietrich of Carson Research, and it recognizes that if the S&P 500 has delivered a greater than 3% year-to-date return on Valentine's Day, the rest of the year return positivity rate is nearly 94%. There's only two down years the rest of the year, and that was 2011 and 1987. We all know or remember what 1987 was about. That was, Black Monday. The market crashed 20+% in a single trading day. Right? That took an exogenous type event, of course. 2011, we had the European debt crisis. Right? Some contagion fears spilled over to our domestic markets. That's it. I mean, 90, that's a big win rate, folks, right? Secondarily, if is secondarily even a word? Um, Having said that already, Look at the median and average returns here at 13.7% each. I mean, that's pretty good stuff, right? But here's a concern, right? And let's travel over to Ryan's um, feed. He's a friend of mine, does fantastic work. Um, but something else happened. Remember in January, we undercut the price of the December low from last year. And there's a really good quant associated with that bearish feat of strength, so to speak. And Ryan alluded to this. I've alluded to that fact, that quant. Yeah, here it is. Right. We talked about this in January. We discussed this. We outlined this in our macro market research report to Finom Group members, exclusive content for our contributor and premium members. We outlined this very quant back in January when it occurred. We undercut the December low. And as you can see here, when you undercut the December low, the positivity rate for the rest of the year sucks, right? It's basically a coin flip, but the returns are negative. The average and median returns are negative. So what do we have here, right? You have a positive quant followed by a negative quant, right? Or a bearish quant even. When you break the December low in the first quarter of the new calendar year, the positivity rate plunges and the returns the rest of the year are negative. So again, a somewhat bearish quant, but we just had a bullish quant achievement. So what are we to do with these two conflicting pieces of data, or quant and we need to go further, right? We need to take our quantitative analysis to the next level. So let's see if we can do that very thing. We certainly can. Here, as you can see, side by side are the two quants. And what we come to recognize are the dates, right? Here's the December low indicator, and here's the Valentine's Day indicator. So what I want to do from here is match up the dates. When in the past did we gain 3% or more in the Valentine Day indicator? This is a previous chart which shows 4% or more, but you can see now, even if you drop the parameter down to 3% or greater, you still get the same thing, right? Here with 4%, you still have 1987 and 2011 as the negative year. So I don't want to confuse anybody. But in Ryan's latest update, he offered 3% or greater, and you still get the same results. Nonetheless, if we put these signals side by side, we start here with the Valentine's Day bullish indicator. 1950s, none of the dates match. 1960, 61, 3, 67, 61, none of the dates match, which tells us that so far up to the 1960s, if you've had the Valentine's Day bullish indicator, you generally have not also undercut the December low. So this may prove void. All right, let's check out the 70s, 71, 75, 76. None of the dates match again. Fast forward to the 80s, and there you have it. 1980, we have a match for the Valentine's Day indicator and the December low indicator. Now, we know bullishness over here. So let's see when you also undercut the December low, if the rest of the year was bullish, given that you also had a Valentine's Day indicator positive. And it did. Full year return was up 25%. The final three quarters were up 33% in 1980. So again, let's fast forward. Valentine's Day indicator 83, 5, 6, 7, 8, 9. Wow, a lot of positives there. None of the other dates match. So far, we have one matching date from the two quants. Let's see, 1989, no, 1991. we have a match. And again, using the December low indicator because it's a more bearish, forward indicator, 1991, rest of the year or final three quarters, up 11.2%, up 26% year for the whole of the year. So in both occurrences that we've been able to see so far, even though you've undercut the December low, if you had a quick recovery by Valentine's Day, if you've had a quick recovery by Valentine's Day, you still had an overall positive signal using these two different indicators. 95, 96, 97, 98, 96, and 98 in the December low indicator match. 96 and 98, fast forward. Yep, positive, 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 positive. Notice that we have double digits on all the like occurrences as well. All right, 2011, 12, 13. No. 17, 19, 20. No. 20. And again, up 45% the final three quarters. We know that was COVID, and up 16% year to date. I'm sorry, on the total of the year. And then and now, nothing in 24 and 2025. You have both. So what we can learn from this is there have been 5 occurrences where you triggered the Valentine's Day indicator and you broke the December low in all 5 occurrences. If we cross-reference the data, the rest of the year was positive and up double digits, folks. Up double digits. And that's basically how you take your quantitative analysis skill set to the next level. 1980, the rest of the year up 16%, 1991 up 14%, 1996, 1998, 2020. Question we started out, this video with was, should we be looking forward to upwardly revising or issuing a new price target objective for the S&P 500 in 2025 or by year end? I still fall back to first things first. We have to hit 6150, which was our by July price target objective. Once we do that, we think the data is here, and we have a host of other data that also lends itself very positively for the S&P 500 in 2025. What you're looking at here is the average annual price performance during the decennial cycle for a year 5, right? 2025 is a year 5. It offers the biggest returns, and it has the highest positivity rate, by the way. Year 5, the mean return, the median return, the positivity rate. In fact, you've only been down once since 1885, but not on a total return basis. And that year was 2015. 2015 delivered a slightly negative return, but if you include the S&P 500 dividend, you were up about 1%. So on a total return basis, the market has never delivered a negative return in a year 5 of a decennial cycle. So with that, I hope you enjoyed this video. Have a great trading week, everybody. Tune in to Finom Group's next report. And if you don't get our exclusive macro market research, consider subscribing to our contributor or premium membership. Take care, everybody.